So the Federal Reserve came out, they had their meeting, the statement is there, the press conference, all that news, the market digested it. What happened? Well, of course, it wasn't so good. The interesting thing was what happened before it. And I'll look at that today. I'll give you some information. I'm going to give you the details of what's happening exactly. The first thing I want to look at is the Fed, specifically all the information surrounding it. The second thing is the markets. I'll give you the charts. I'll also give you the analysis behind the scenes. The third thing is the economy, because that's really what's important to you, your wallet, okay? All of that and more. Let's begin. First things first. Fed likely to hike rates in March as Powell vows sustained inflation fight. So Powell comes out and he says, we're not going to increase interest rates right now. We're going to do so in March. This is what I had said, and this is what was understood. They weren't going to hike rates right now, even though some were suggesting not only were they going to hike rates, but they were going to do so 50 basis points and shock the markets. That didn't seem very likely. Of course, anything is possible, but that wasn't the case. And here we are, waiting. Again, waiting. How did the markets react? Well, I believe I have the daily chart set up right here for the NASDAQ, and you could see for yourself it was a red day. Now, the market didn't specifically like this. I mean, you could look at particular stocks and see how they did, but ultimately it started to look good in the morning. Things were great. Things were all right. And then it changed. When we take a look at the details of what has happened here in the last little while, it just shows you that the markets are really, really relying on the Federal Reserve to keep everything swimming along. But of course, we're changing. We are going back to something we haven't seen for years, and that is the threat of rising interest rates. They haven't done it yet. What they have done, and what we'll talk about here, is the fact that they are, going through this tightening. I wouldn't really, personally, I don't call it tightening because of how, loose things are. But anyway, this is a quote from Powell. I would say the committee is of a mind to raise the federal funds rate at the March meeting, assuming that the conditions are appropriate for doing so. Essentially saying that, look, if anything happens, we'll change, but that's the way it's looking. They've made it very clear. March is the date. And they've been signaling this for a while, kind of hinting towards it, because they are going at this super slow pace. They're way behind all the data. And of course, here we are today. We are going to be led by the incoming data and the evolving outlook. Like I said, they're behind the curve. They know that, but it's all for show. It's all for show at this point here. Take a look. Goodbye, Mr. Gradual. Hello, Mr. Nimble. Fed Chair Powell tears up the rate hike script. I mean, it's quite nonsense when you think about it, but of course, like I said, this is all that, these big investors, they look at this stuff and they just eat it up. This is a quote. We are going to need to be, as I've mentioned before, nimble about this. The economy is quite different this time. I found it funny that he said it's different this time because we always make that joke, but he literally said that. So anyway, I just think that it's funny to see what happens here. All these little developments every day that are going on. You and I look at all these nuances and you could see the way that the market flips from one side to the other. I mean, why? Market implied number of rate hikes by December 2022. So of course, as the stock market started to decline over these last few days, red, it started to suggest that, maybe they won't actually increase rates. Well, of course, that flipped real quick as soon as the market turned around. I mean, that's really not what they are supposed to be looking at. The Federal Reserve is supposed to be looking at jobs. They're supposed to be looking at price stability. And yet, the market seems to be a big concern. Well, I thought this was interesting because according to, you'll see it right here, Fed signals the start of a hiking cycle soon, asset purchases to end in early March, nothing new on the balance sheet reduction. Per my Monday post, it's what I expect, but not what I think that should have been done. The Fed falls further behind the economic developments. And that's the truth. Because yes, this is what we all expected, right? This was it. And at the same time, when we watch all of this, it should have been something else. They should have been increasing rates from last year. And they didn't have to do it at a quarter point. Why did they have to do so? They could have come out and just tested the waters and say, hey, maybe we'll do this once a month and we'll do it at 0.1%. Why not? Why can't we do that? Why does it have to be a quarter point? Why can't they do so? They could have even suggested it just to see how the market would react. Because if it was a scheduled every month small number, maybe they could have got away with it. Started it earlier, markets wouldn't be so jumpy. What has happened, though, to these markets over this period of time? Well, it's become more concentrated. And why? It's because they're looking for safety. Of course, they're looking for yield. Yes, we get that. But they're also looking for safety. And, you can see the weight in the S&P 500. Facebook, Amazon, Apple, Microsoft, and Google over this period coming off the peak, but still 23%. Huge, right? And then the 5 largest stocks back from 2000, Microsoft, Cisco, GE, this is a funny one because it's fallen off. You look at ExxonMobil falling off the Dow and really should be in the Dow at this point. But that's the way it fluctuates. Anyway, it was 18% at its peak. And now today, that grouping is 8%. So things have really changed, no doubt. I mean, depends on what time frame we're looking at. But clearly, there has been dominance in a few names carrying the market. That's still going on today, although there is a rotation happening. Your favorite friend, Bill Ackman. We recently purchased more than 3 million shares of Netflix, which makes us a top 20 holder, saying it's all good. And they believe that the market provided them with this opportunity. What do you think of Bill Ackman's recent purchase? Do you believe that Netflix has hit a bottom or close to it? I want to know what you think in the comments down below. Let's get into the next level. Let's talk about it. While you're waiting here, why don't you give a thumbs up to the video? Smash that like button. It's right down below. I appreciate that. This was funny. If you have a minute, check this link out in the description. Quote, "You have no home here. Jimmy Boy Cramer blasts speculative SPACs for taking down the stock market." This is the quote. "There's no more Jimmy Chill when it comes to SPACs." I don't know if that's like a term that he uses. I don't know, but it's funny. Okay, so in this little video, you can watch it for yourself. Basically, he's saying the SPACs are the reason. Like, money's being thrown at it. And he said, I'm not talking to anybody that's doing a SPAC to promote your SPAC on my section of this CNBC program, and said, we don't want people to lose money on this channel. I'm going to do what I can to protect them. In my opinion, there's no difference between a SPAC and a normal IPO and any particular stock, a cryptocurrency. Every asset has a level of risk. The problem, I believe, is this perception that people are given when they see, oh, that thing did really well, so I can do very well at this thing. No, that's the mentality behind it. People should be more aware of what they're getting themselves into. And so with everything that's been happening, I found it funny that there's been this new trend to follow what people in the government are doing, and they're buying stocks, and all of those activities which are posted publicly are then followed by other people, and hey, making good money as a result. What do you think of that? Interesting to say the least. We go into this, I mean, it's something that, quite frankly, most people don't care about. The trade deficit in goods tops $1 trillion in 2021 for the first time as US gobbles up imports. What I think is important about this is that whenever you owe money to an institution, you owe money to an individual, you owe money to a country, you are always going to be indebted to them. They control, not you. This is worrisome. You don't want to see a deficit. You want to see a surplus. You want other countries out there, you want other people out there owing you the cash. If you were a lender, you would be the one making the rules. You'd be the one dictating the policies. You would be the one who can make, sort of control everything like a puppet master, marionettes. Bubbliest housing. Canada ranks as the world's second most overheated market. New Zealand, I'm going to have to say Canada is a greater number, but that's just because I want to give Canada the crown, okay? In this case here, either way, it's just ridiculous. Price to rent ratio, price to income ratio, the amount, the price growth is just stupid, okay? This is completely and entirely unsustainable, and as interest rates rise, which, by the way, Canada said, oh no, we're going to increase interest rates, but not yet. Not yet. We really, really need to increase interest rates to stop inflation, but not yet. I mean, it's just ridiculous. Oscar Mayer hot dogs and Velveeta cheese will get more expensive. That's strange to say the least. I don't know. I guess, I don't know if I've ever eaten either of these things, but I think, the shortages, supply chain, all of that stuff still happening today. Just giving you a quick update on that. Look, it affects people. The more that this happens, the more of a problem in the economy. Deutsche Bank, I've been covering this one for years. Deutsche Bank, who, by the way, I had just seen a pop-up come up on my CNBC. It was talking about Deutsche Bank. There it is. Post a surprise profit on strong investment bank performance. Deutsche Bank. Crazy to say the least. Deutsche Bank blames client in $565 million FX mis-selling suit. Oh, that's right. They were selling derivatives that the buyers had nothing, they didn't even know what the heck they were buying. Okay, that's what this thing is about. We'll see what happens. If there's anything relevant, I'll bring it to you. I just think it's crazy that these companies still, after all these years, are going through this nonsense. Derivatives, most of them are just simply utter garbage. And yet, they consume it all. Derivatives, I think of them like a tornado. As they pass through, they just grab more and more of that garbage, whipping things left, right, and center, doing damage all over the place. But most people, if it's not in front of their face, they're not going to see it. It's just the way it is. I want to end it there. If you found it informative, hit that thumbs up button. It's right down there below. You got to do that to support the channel. If you haven't seen this video yet, definitely check it out. Click it. I'll see you over there. Take care.